It's evident that trends in prices for any freely traded entity can be very volatile, almost haphazard at times. One technique for dealing with this phenomenon is moving averages, which is a statistical technique for smoothing out these fluctuations and presenting us with the true trend. A lot of people think the moving average is a panacea for all their investment and trading troubles. I disagree. For me, moving averages are just one more tool in the technical arsenal to be used in the weight of the evidence approach. Like all techniques, they have their strengths, but they also have their weaknesses. Let's take a closer look.
Moving average attempts to tone down the fluctuations of stock prices into a smooth trend, so that distortions are reduced to a minimum. It's important to remember that moving averages, just like trend lines, should be considered as dynamic levels of support and resistance. They're dynamic because, unlike specific levels, which by definition remain constant, moving averages keep changing their values. If a specific moving average has not worked well in the past on a particular security, there are few grounds for suspecting that it will in the future, and vice versa. The three types of moving average used in technical analysis are simple, weighted, and exponential. There are also variable, triangular, and time series moving averages. The construction and use of these averages are different. Therefore, each type will be dealt with in turn. But I'm going to limit the discussion to the three on this slide, and start with the most widely used and I believe the best type of average, which also goes back to my philosophy of keeping things simple. So let's begin with a simple moving average. A simple moving average is by far the most widely used. It's constructed by taking a mean average of the data over a given time span. The resulting number is known as the average or mean average. Now, in order to get the average to move, a new item of data is added and the first item on the list subtracted. The new total is then divided by the number of observations, and the process is repeated. This chart compares the price of the S&P SPDR ETF, the SPY, with a 13-week moving average. It shows that the average changes direction well after the peak and trough in the price, and is therefore late in changing direction. This is because the moving average is plotted on the 13th week, whereas the average price of 13 weeks of observations actually occurs halfway through the time span, that is, in the 7th week. That means that if it is to reflect the underlying trend correctly, the latest moving average plot should be centered, that is, plotted on the 7th week. And that's what we see in the bottom window. The good news is that it turns fairly closely to the turning point in price, but the bad news is that it's necessary to wait 6 weeks before it's possible to ascertain whether the average has changed direction. See how the centered moving average plot ends 6 weeks prior to the end of the chart. A time delay, though an irritant, is not particularly critical when analyzing other time series such as economic data. But given the relatively rapid movement of prices in the financial markets and consequent loss of profit potential, a delay of this nature is totally unacceptable. Technicians, therefore, have found that for the purpose of identifying trend reversals, the best results are achieved by plotting the moving average in the final week. Changes in the trend are then identified not by a reversal in the direction of the moving average, but by the price itself crossing its moving average. A change from a rising to a declining market is signaled when the price moves below its moving average, and a bullish signal is triggered when the price rallies above the average. Since the use of moving averages gives clear-cut buy and sell signals, it helps to eliminate some of the subjectivity associated with the construction and interpretation of trend lines. More often than not, it pays to take action based on moving average crossovers, but only if you can look back and see a fairly consistent relationship between the price and the moving average. As a general rule, the shorter the data period you're looking at, the greater the potential for random noise and therefore false signals. That's why you really need to go back and test moving average crossovers on intraday charts. Now let's look at some moving average characteristics. A moving average is a smooth version of a trend, and the average itself is an area of dynamic support and resistance. In a rising market, price reactions are often reversed as they find support in the area of the moving average. These arrows show how the hourly close for Google found support and resistance at its 60-hour moving average. If the rest of the evidence agrees, it's not a bad idea to wait for the price to reach its moving average prior to making a purchase. After all, if the moving average represents support, you can place a stop below support, in other words below the moving average. Similarly, a rally in a declining market often meets resistance at a moving average and turns down. The more times a moving average has been touched, that is, acts as support or resistance, the greater its significance when it's been violated. A carefully chosen moving average should reflect the underlying trend. Its violation therefore confirms that a change in trend has taken place. In this 1-hour chart of Google, this 100-hour moving average works pretty well, and is a good reflection of the underlying trend. It doesn't always work as well as this, of course, and even in this instance, there were a couple of whipsaw or false signals. If the violation occurs where the moving average is still proceeding in the direction of the prevailing trend, this development should be treated as a preliminary warning that a reversal in trend has taken place. Confirmation should await a flattening or a change in the direction of the moving average itself, or should be sought from alternative technical sources. Crossovers of flat moving averages generally offer more reliable signals than those with a steeper angle of ascent or descent, just as trend lines with steep angles of ascent or descent offer less reliable signals when penetrated. Here we see a 200-period moving average for the 30-minute chart of Microsoft. The two penetrations on the left developed when the moving average was relatively flat. However, the one on the right probably failed because the moving average angle was much steeper. Generally speaking, the longer the time span covered by a moving average, the greater is the significance of a crossover signal. For instance, the violation of an 18-month moving average is substantially more important than a crossover of a 30-day moving average or a 200-period moving average of a 5-minute bar chart. That again goes back to the idea that the longer the time span, the bigger the trend that's being monitored. Reversals in the direction of a moving average are usually more reliable than a crossover. In instances in which a change in trend occurs close to a turning point, a very powerful and reliable signal is given. However, in most instances, an average reverses well after a new trend has begun, and so is only useful as a confirmation. In short, think of an average as a type of moving trend line, which, like a trend line, obtains its significance from its length, the time span, the number of times it's been touched or approached, and its angle of ascent or descent. A crossover is any penetration of a moving average. However, close observation of any chart featuring a moving average will usually reveal a number of whipsaw or false signals. How can we tell which ones are going to be valid? Unfortunately, there's no way of knowing for certain. Indeed, many whipsaws cannot be avoided and should be regarded as a fact of life. That's why I prefer to use trend lines wherever possible. However, it is possible to avoid some of these close calls by using some filtering techniques. One important filter is to choose between bar and close-only charts. Moving averages are usually constructed from closing data. These are more reliable than intra-session prices because they reflect positions that investors are willing to carry overnight, or in the case of weekly charts, over the weekend. Moreover, bar charts are subject to intraday rumors and other random noise. It's certainly true that the bar charts are penetrated intraday and therefore offer more timely signals. However, there are also a far greater number of whipsaws or misleading signals. That's because the intraday trading can be subject to manipulation or distortion by knee-jerk emotional reactions to news events. For this reason, it's usually best for the closing price to penetrate the average before concluding that a crossover has taken place. Here we see both versions for the S&P and a 30-day moving average. Here is the whipsaws for the bar chart and these are the ones for the line chart. As you can appreciate, there are far fewer on the line chart, and when we add them to the full signals in the bar chart, the close-only version wins hands down. One exception to using close-only charts would be if the moving average was touched or approached by the highs or lows of the bars on numerous occasions. In this instance, it would mean that the moving average represented an unusually strong resistance or support level. Consequently, its penetration would have greater significance. Another form of filter is to use a percentage penetration. For example, we may decide to take action on a moving average crossover for which a 3% penetration takes place, and to ignore all the others. Violation of a 40-week moving average might result in an average price move of 15 to 20%. In this instance, a 3% penetration would be a reasonable filter. But on the other hand, since 3% would probably encompass the whole move signaled by a 10-hour moving average crossover, this kind of filter would be of no use whatsoever. This chart features the Eurotop index together with a 40-week moving average and two bands, one 3% above the average and one 3% below. Buy signals are generated when the price crosses above the upper line, and sell signals when it crosses below the lower one. The sell signals remain in force until the price crosses back above the upper 3% band, and vice versa. This has the effect of filtering out some of the whipsaws, yet doesn't give up too much in terms of timing. Some analysts, recognizing that a one-period whipsaw is quite common, require a moving average crossover to hold for at least 2 periods. If we go back to the S&P example I showed earlier, and I place the whipsaw arrows for the close-only signals, you can see that the 2-day filter would have eliminated all of the whipsaws. Now I picked this example at random, so obviously not all 2-period filters will work this well. Indeed, by waiting for the second period, it's quite possible that the price could have moved well away from the average before the filter kicked in. A more sensible method might be to use a combination of the period and the percentage penetration for deciding whether a crossover is valid. A useful tip is to wait for a moving average crossover to take place at the same time a trend line is violated or a price pattern is completed. These two dynamic levels of support or resistance really reinforce each other, so when penetrated, the signal is that much stronger and reliable. Here we see a 40-week moving average for JP Morgan, along with a double trend line and moving average penetration just here. Later on, a major trend line violation developed as the bear market was getting underway. Note also the fact that in the ensuing volatile environment, the moving average crossovers completely failed. Sometimes it's possible to see a moving average crossover accompanied with exceptionally heavy volume. In such circumstances, you could lower your standards of what represented a decisive breakout, since the expanding volume would emphasize enthusiasm by the buyers or fear by the sellers depending on the direction of the break. This chart features a 30-minute close for Comcast with its 125-period moving average. Underneath is a 13-period moving average of the volume, and that filters out the heavy volume often seen at the opening and the close. Note how this trend line is violated simultaneously with a 125-period moving average. The key, though, is a rapid expansion in volume. Later on, we see another trend line violation with more volume. Finally, in a recap of our volume presentation, note how these red dashed arrows show that volume leads price, and this negative characteristic was also confirmed by a trendline break. During a trading range, moving average crossovers have a tendency to be counterproductive. In this example, we have a couple of whipsaws, but by this point, it's fairly obvious that the price has entered a trading range. In such situations, it's usually best to ignore the moving average entirely and go with the two trend lines that mark the outer boundaries of the range. Now we can extend the barriers, and when either of them is violated, go with the breakouts. In this case, it was an upward one. The choice of moving average depends on the type of market trend that's being identified, i.e. intraday, short, intermediate, or primary. Because different markets have different characteristics, and the same markets go through different cyclic phenomena, there's no such thing as a perfect moving average. In recent years, extensive computer research has been done on the optimum moving average time span. The conclusion from all sources is that there is no one perfect time span. What may work extremely well in one market over one specific period of time is unlikely to be duplicated in the future. When we talk about choice of time span, we're really trying to identify a moving average that will work most of the time with a specific time frame, that is, short, intermediate, or long. The important rule is always try for consistency, never ever for perfection. Now I can't stress that enough, because perfection just does not exist in psychologically driven markets. Generally speaking, long-term time spans are less influenced by manipulation and knee-jerk random reactions to unexpected news than are short-term ones. That's why long-term time spans usually give the best results. Both daily and weekly averages work best at or above the 40-period time span. Research also shows that simple averages generally outperform weighted and exponential ones. Recognizing these limitations, the following time spans are recommended. First, for long-term charts, attempting to monitor primary trends. Note that they all have a quarterly span: 200-day, 39 weeks, 9 months, 52 weeks, 12 months, 18 months, and 24 months. For intermediate trends, 30-day, 6-week, 50-day, 10-week, 65-day, 13-week, 20-week, 26-week, 200-day, 39 weeks. Note there is an overlap in the 9-month, 39-week camp. I have no problem either with 40 weeks. It's just that 39 reflects a calendar quarter. For short-term spans, 10-day, 15-day, 20-day, 25-day, and 30-day or 6 weeks. For hourly charts, 45-hour, 75-hour, 125-hour, 150-hour, and 200 hours, though I find that the shorter you go, the less reliable the signals tend to be. The same would be true for 30-minute periods, where the following are suggested: 30 period, 60 period, 125 period, and 200 period. A technique that has a lot of potential but is not widely used is to advance a moving average by shifting it to the right. In this chart, the red average is a straight 45-period simple moving average, or SMA. The blue line is also a 45-period average, but it has been advanced by 7 periods. You can see this as the red average turns here and the blue one is delayed slightly. The advantage of this approach is that it delays the crossover and filters out occasional whipsaws or false signals. You can see that from these arrows, where the red average experiences a whipsaw. Of course, nothing is perfect, and this brown arrow highlights a whipsaw from the advanced average. Most of the time, this technique works well, but we do have to recognize that in a fast-moving market, the advancing technique will result in late signals. It's often difficult to know how much to advance a moving average. Experimentation is obviously the answer. But a possibility that I favor is to advance the average by an approximate square root of the time span. For example, a 36-week moving average would be advanced by 6 days, the square root of 36 being 6. In this chart I've used 7 days because the moving average span at 45 is close to 49, 7 being the square root of 49, and so forth. When buyers and sellers are evenly matched and prices move in a narrow range, that means that a slight push from either side is often followed by a strong price move. This kind of situation could be identified by plotting several moving averages and observing when they're all approximately the same point. This chart features several moving averages for Amtel Corp. Just here, all of them were in an unusual state of convergence, and this was confirmed by a break below this red line. Later on we see another convergence, this time with a confirmed break to the upside. In effect, this convergence of moving averages reflects a very tight balance between supply and demand. When this unusual quietness is resolved, it's of little wonder that prices move in earnest. The joy of the trendline breaks is that they give us an objective barrier for taking action, since the violation of a carefully chosen line tells us when the balance is unequivocally shifted to one side or the other. Some techniques of trend determination involve more than one moving average. Signals are given by a shorter-term moving average crossing above or below a longer one. This procedure has the advantage of smoothing the data twice, which reduces the possibility of a whipsaw, yet warns of trend changes fairly quickly after they've taken place. In this regard, this chart features the MSCI World Stock Index, the exchange-traded fund for which is listed in New York under the symbol ACWI. Two averages that have traditionally been used for identifying primary trend moves are the 10 and 30-week spans. Signals are given when the red 10-week moving average crosses below the blue 30-week moving average, and when the 30-week moving average itself is declining. This development warns that the major trend is down. It's not assumed to have reversed until both averages are rising simultaneously, with the 10-week higher than the 30-week moving average. A valid signal is not given if the 10-week moving average rises above the 30-week average while the longer average is still declining, and vice versa for bull markets. That's what happens at this orange arrow. I put the next sell signal in, even though technically the model was still bearish. By definition, these warning signals always occur after the ultimate peak or trough of stock prices, and serve as a confirmation of a change in trend rather than as the actual juncture points themselves. If the signal develops close to the final turning point, then it can be acted on in a timely and practical way. May 2009 presented such a signal. On the other hand, if it's triggered some distance from the previous peak or trough, then it can merely be used as confirmation. Even that information can be useful, because if you're going to run into trouble, it will usually be when you act on a contra-trend signal. A clearer understanding of the direction of the main trend through this double moving average approach will offer you a less of a chance that the contra-trend signals will be executed. Again, later on in 2010, we see a valid signal because the cross came when the blue 30-week moving average was declining. However, it proved to be a whipsaw, and we end the chart on a positive note. A simple moving average can only correctly represent a trend from a statistical point of view if it's centered. But centering an average delays the signal, as we discussed earlier. One technique that attempts to overcome this problem is to weight the average in favor of the most recent observations. A moving average constructed in this manner is able to turn or reverse direction much more quickly than a simple moving average, which is calculated by treating all of the data equally. In this chart, the simple moving average, or SMA, is slower to reverse than its weighted, or WMA, counterpart, which is colored in blue. We see the same thing earlier on at this bottom. The interpretation of a weighted average is different from that of a simple average because the weighted average is more sensitive. A warning of a trend reversal is therefore given by a change in direction of the average rather than by a crossover. An exponential moving average, or EMA, is a shortcut to obtaining a form of weighted moving average. Without going into the math, an EMA, like a weighted moving average, gives greater weight to the more recent observations, but with the use of an exponent which varies with the time span of the average. The effect vis-à-vis the simple moving average is the same in that the EMAs turn quicker than the SMAs. The exponent used varies with the time span of the moving average. Owing to the way they are calculated, price crossovers and EMA reversals occur simultaneously. Buy and sell signals are, therefore, triggered by crossovers just like a simple moving average. You can see an example of this from this hourly chart of Yahoo, where the green line is a 65-period EMA. See how it's penetrated on the upside at precisely the same time that it reverses. Sell signals have exactly the same characteristics, but in reverse. This chart shows the three types of calculation plotted on the same chart. You can see that at pretty well all times the weighted WMA average is the most sensitive since it hugs the turning points more closely. The simple and the exponential alternate depending on how the data falls. My experience is that in most situations the simple moving average works best, though I have to admit that unless I'm relying on a longer-term time span, such as the 200-day, 9-month moving average, I rarely place much emphasis on the crossovers, unless other evidence, such as the trendline break, suggests that the trend is reversed. I must say that I've never seen any research that evidences a superior performance by weighted or exponential moving averages. However, in a practical sense, I found that the 65-week or 1.25 year time span seems to work fairly consistently in the form of an EMA. This chart shows the 65-week EMA of the Canadian dollar-US dollar relationship. These are the good buy and sell signals, and these are the 4 whipsaws. Note that the EMA turned back over 7 rallies and reactions during this period, demonstrating that the EMA was a good dynamic level of support and resistance. Now, you shouldn't expect all markets to behave this well, but if it's possible to look back at several years of data and see such a good relationship as we can with the Canadian dollar, then it's reasonable to expect it to work reasonably well in the future. If not, then lower the importance of the average in your analysis. In summarizing moving averages, one of the basic assumptions of technical analysis is that stocks move in trends. A moving average is constructed to help smooth out the data so that the underlying trend will be more clearly visible. 2. Ideally, a simple moving average should be plotted at the halfway point of the time period being monitored, a process known as centering. But since this would involve a time lag during which stock prices could change rapidly and lose much of the potential profit of a move, it's plotted at the end of the period in question. 3. This drawback has been largely overcome by the use of moving average crossovers, which provide warnings of a reversal in trend, and by the use of weighted or exponential moving averages, which are especially more sensitive to changes in the prevailing trend since they weight the data in favor of the most recent periods. And 4, there is no such thing as a perfect average. The choice of time span always represents a trade-off between timeliness, catching the trend at an early stage, and sensitivity, catching the trend too early and causing an undue amount of whipsaws. For short-term trends, 25 and 40-day spans are suggested, but for longer-term spans, 40 and 45-week averages are recommended. A helpful time span using monthly data is 12 months.
Well, that wraps up our first session on the basics. As we progress, you'll better appreciate these concepts as you see how they fit into the other techniques. Remember that prices move in trends, which are determined by market participants changing attitudes to the emerging fundamentals, rather than the fundamentals themselves. Apply common sense at all times, and above all, make sure you keep things simple. And with that, I'll see you in the next session.